We have a big gap down back below the 60-minute moving average. I said on Friday that even though we gapped up, we were sideways, and it looked more like a continuation of the trading range than a resumption of the bull trend. And now, as is common in a trading range, we have a double top, and if we stabilize here, then we'll have a double bottom breakout mode. The bulls want a measured move up, and the bears want to break below the neckline and a measured move down. We have a big gap, so we're far below the average price. The moving average will fall quickly over the next hour. Typically, when you have a big gap, you have a 20% chance of a trend from the open, and it could be up or down. So 20% chance we just go straight up, 20% chance or straight down. 80% chance we'll get some kind of a trading range over the first hour. And typically, you can see we're below the moving average. If we sell off, the bears will try to get a double. If we sell off in reverse, the bears will try to get a double top at the moving average, or they'll try to get a wedge rally at the moving average. And sometimes you can get very strong buying, yet you still get a swing down. And the bulls hope that we get a double bottom or a wedge bottom and an early low of the day. In any case, all four of these scenarios, the market is mostly sideways with at least one or two reversals in the first hour. That is what happens 80% of the time when you have a big gap. 20% of the time you get a relentless trend right from the open, up or down. Now, for the bears, let's say one closes on its low. Then we'll be far below the average price, and traders have to decide, do they want to sell far below the average price? And sometimes they will. They want a trend from the open, bear trend. So if we get a gap down here, a very big gap down, here's the moving average, and we start to get 2 or 3 consecutive bear days, that increases the chances that we'll get a big bear trend. Traders will start selling below bars and selling bear closes. Bulls want the opposite. They want a series of bull bars on the open, and then a bull trend from the first bar. So gap down, and the bulls want 2, 3, 4 consecutive bull bars, and they'll start buying closes and buying low bars, hoping for a trend up. These trend from the open bull and bear trends come about 20% of the time when you have a big gap. Weekly chart, we had 4 strong bull bars, and last week was a doji. That is a bad stop entry bar for the bulls and the bears. For the bears, it's a pullback to the moving average and a bear trend. We have a lower high, lower high. We have a low, a lower low, and they're hoping that we channel down. But after 4 big bull bars, the bears will probably need some kind of a micro double top. There probably will be buyers below last week's low. And it's not a very good buy signal bar either, and therefore there probably will be sellers above last week's high. So if there are sellers up here and buyers down here, what is likely the next week or two? Sideways. Daily chart, we gapped up on Friday and created a 3-day island bottom. And we had an island top here, island bottom here, and then a 1-day island top here. And I always say that island tops and bottoms are minor reversal patterns. The bears want this to be a small double top, break below the neckline, and get down to last February's low, which is where I think we're going. The bulls want at least one more leg up. They have a bull trend, a bull flag, a breakout above the bull flag, and they're hoping today is simply a pullback from that breakout. However, there probably would be sellers not far above the December 12th high. That's the top of that crash that we had. So we're going down here, and the market's simply deciding, do we go up here first, or has the move down begun? And nobody knows yet. Sideways for 6 days. Will we start to get a trend day out of this? big bear bar, always in short, gap down and a bear bar, always in short, but tail on the bottom, probably buyers not far below the low of the bar. We went below the Globex low. This is really annoying. Trade stations scaling. But anyway, we went below the Globex low and on the very first bar of the day. Globex high, Globex low, a magnet every day, and 90% of the time you break out of the Globex range, and we did it right here in the first few minutes of the day. So can you buy the close and buy more lower? Yep, but probably better not to do that. Risk is big. If you buy below one, where's your stop? A measured move down based on the height of one. Or do you look at the weekly chart and put the stop below last week's low? Here's last week's low. Remember, we have a double top. This scaling is really a nuisance. Anyway, this is the 5-minute chart. We have a double top with last week's high. Here's the neckline. The bears want a break below and a measured move down. And the bulls are hoping that we had a 4-week rally, a week-long sell-off, bull flag, break above the bull flag. Here's the bull flag. And this is a pullback, and that we resume up from here. Can you buy above 2? Well, you cannot buy above 1. It's a bear bar. Probably sellers above 1. And the tail on the bottom of 1, not good enough for bears hoping for a bear trend. And not a lot of bears will sell this far below the average price when you have a bar like 1 that is not all that much above average in terms of bearishness. That tail on the bottom will make a lot of bears not want to sell below the low of 1. So they're probably have sellers below 1 and buyers above 1. We're probably going to have to get closer to the 2 moving averages, especially the 5-minute moving average, before the market decides on its direction. So looks like it's going to be like 80% of the time when there's a big gap down or a big gap up. The market goes sideways until it gets closer to the moving average. The bulls will try to get a double top or a wedge rally, and then the bears will try to get a wedge top, a wedge bear flag at the moving average for a double top, and then a new low of the day and a measured move down. And the bulls will try to get a double bottom or a wedge bottom and an early low of the day. With 1 having a big bear body like that, most traders are not going to be eager to buy above 2. If 2 is a big bull bar closing on its high, some traders will buy taking a chance, but most will wait to see if we get 2 consecutive bull bars. It's already a decent sized bull bar, so even if it closes on its high and does not get any bigger than this, it's a credible candidate for the low of the day. Maybe 25% chance it would remain the low of the day. If it has a conspicuous tail, 3-tick tail, 4-tick tail, most traders will wait. Good bar for the bears. Bears hoping for a bear trend from the open. It is south of close, but you're risking to above 1, so risk is fairly big. Bears trying to get below last week's low, but last week bad sell signal bar on the weekly chart, and therefore probably buyers not far below last week's low. Bulls hoping for a reversal up, early low of the day, bottom half of a 6 or 7 day trading range on the 60-minute chart does not look all that bearish, just like this did not look all that bullish. For the bulls, possible low of the day. So swing bulls will buy above 1. Others will want higher probability. We'll wait to see if we get 2 or 3 consecutive bull bars. If you have a conspicuous tail on the top of 3, most bulls will wait. Bears hoping that we continue down to last week's low. they're hoping this is the start of a big bear trend day. Bears, I would get out above any bull bar, for example, bar 3, and I would get out 4, 5, or 6 ticks above any bar, including a bear bar. And bulls want to buy, but they only want to buy if there's a bull bar closing near its high, or if they see 2 or 3 consecutive bull bars. These 2 big bear bars reduce the chances that today will be a strong bull trend day. So it makes it unlikely that this is going to be a bull trend from the open. And therefore, if we rally, we'll probably go mostly sideways to up to the moving average. And the bears will try to get a wedge or a double top there. For the bears, they have a gap down in 2 bear bars, bear trend. 3 is a pullback in the bear trend. So therefore, theoretically, it's a sell below 3. But with that big bull body, and the market far below the moving average, not a lot of traders will sell on a stop below 3. Some bulls buy above 3, hoping that we race up above 3. And if we go above 3 and do not race up, they scalp out. Good bull bar 3, far below the average price. A lot of bears will not sell below 4, even though double top 1 and a low 1 bear flag. They don't want to be selling this far below average when this bull bar means the sell-off is not far above average in terms of strength on the part of the bears. Bears want to get as strong a sell signal bar as they can get with bar 4. But the reality is most bears are not going to sell this far below the average price right after a big bull bar, bar 3, even though we're always in short. Bulls hoping for a second buy signal. We're below yesterday's low. Try to reverse up once, try to reverse up twice. Higher probability. Better to buy above bull bars closing in their highs. Remember, trading range is likely. Try to reverse up once from below yesterday's low, and then above second time. Bears, theoretically, they sold again below 4, but it looks like more buyers than sellers below 3. And bulls, remember, trading range is likely, so it's likely we're going to go mostly sideways, maybe sideways to up toward the moving average. The bulls need a decent buy signal bar, just like a lot of bulls did not buy above 3. They will not buy above 5 unless it closes near its high. But if it does close near its high, it's a reasonable buy. May test the high of the day, may go all the way up to the moving average. If it does not close near its high, a lot of the bulls will wait 1 or 2 more bars to see if we get a big bull bar on 6. Here, not a good buy signal bar, but we have a bull bar closing on its high here, so a lot of bulls bought there instead. Big gap down, big bear bars, first reversal up, second reversal up, bull bars closing near their highs. Traders will buy above those bars. Important bar. Everybody knows the bulls want the bar to close on its high, and the bears are trying to stop that. The bears are trying to continue the bear trend from the open. They're trying to get bear bars closing near their lows to encourage bears to sell closes and sell below bars. Another decent bar for the bears. Tail, not so great. Bull bar 3, not so great. The bulls need another bar that looks like 3. That red line is the low from a couple days ago. 60-minute chart, Thursday's low over here. Bears, double top, neckline, they want measured move down. 3, not high probability up to 2 bear bars. If 4 closes on its high, it would be a better buy. Might get a test of the high of the day. If it does not close on its high, a lot of the bulls will wait to see if 6 closes on its high. Is that a good enough buy signal bar? It might be, but when you're buying in a bear trend, it's usually better to wait until the market gives you very strong signal bars. For the bears, what do? It looks like the bears are sold below 2 scalped. You can see it just went down a little bit and then up. The bears are sold below 4 scalped. Went down just a little bit and reversed up. So it looks like bears are not willing to hold on to their positions down here. Remember, I showed examples of bear trends in the open. They did not have 2 bull bars in the first 6 bars. Bear trend from the open. Lasted all day. Where are the bull bars? We had a bull bar after 6 or 7 bars. Here we did have 2 bull bars. The buy never triggered above this one. This is what the bears are hoping they'll get. Usually when you get bad follow through, you're going to get some kind of a bounce. But this is not typical. And because of that early buying, the market ended up going mostly sideways. Here we had 2 attempts to buy, and then a series of bear bars. Again, 1, 2, the bulls tried to get a second buy, but the first buy never triggered. And that's the same here. The first buy never triggered. Today, the first buy did trigger, so that's a sign of strength on the part of the bulls. 4 decent bear bars. Even if we go above 6, it's probably going to be a trading range. So the bears, 6, a pullback in the bear trend, but probably more buyers than sellers below 6. Most bears do not want to be selling below bull bars. Something of a wedge, 3 legs down, bar high 1, high 2, high 3. The high 2 never triggered, so it's not nearly as bullish as it could be. For the bulls, they want to buy above bull bars closing near their highs. Bar 8 is possible. You can call it a small wedge. You can call it a high 2 with bar 3. In any case, I think the bears will get out above a bull bar. So if 8 has a bull body, I think the bears will buy back their shorts above 8 and then look to sell again higher, maybe a double top 4 or double top 1 or testing the moving average. And the bulls, if 8 closes near as high because of the small wedge, some bulls will buy, others will wait for a second bull bar because they don't want to take a chance of what they got with 3, 4. A lot of times when you're buying in a bear trend, it'll trigger the buy like above 3 and then immediately reverse down. And a lot of bulls wait for 2 or 3 bull bars before buying. Limit order bulls making money, buying below 3, buying below 6. Stop order bulls have not yet made money. In general, I say that if it's sell the close, get out above a bull bar, but sometimes you'll go very far above a bear bar before you get a bull bar, and therefore, if I were short, I would get out 4, 5, 6 ticks above any bar, including above bar 7. This is a mini version of a gap down in a wedge. 1, 2, 3. Here's a small one. 1, 2, 3. Similar to today. Not even looking like a wedge, but we gap down. So 1, then a series of bear bars 2, and then pause, and then 3. And theoretically, it's a reasonable buy above the bull bar, where you wait for 2 or 3 bull bars, and then you buy, hoping that we're getting an early low of the day. Not a strong buy, but possible low of the day. Higher probability, wait for 2 or 3 bull bars. First 8 bars, 3 decent bull bodies. That typically does not happen if the day is going to be a big trend from the open bear trend day. most likely this is going to be one of those 80% of the times where we get an early trading range for the first hour and a half. And the market's deciding, is this the bottom of the range? And if it is, where's the top? Usually it's around the moving average, and usually around the earlier high of the day. There's double top, 6, 8. Decent bear bar, but we're starting to get too many bull bars. Odds are we're going to get closer to the moving average. So it looks like limit order trading. Bulls have been making money buying below every bar today. Below 1, even below bar 2, they made money, even though it's a bear bar closing on its low. So below 1, 2, 3, 4, 5, 6, and now 9. If it's that easy for the bulls to make money, this is probably not the start of a big bear trend. Outside up, can you buy above 10 if it closes on or near its high? You probably can. You certainly can buy for a swing. But look at the past 6 bars, tight trading range. Past 8 bars, tight trading range. Therefore, they're probably sellers not far above 10 and not far above the high of the day. Moving average falling quickly. Normally, if the bears get their double top with 1, for example, it occurs right near the moving average. Most double tops, if you have a gap down and a double top and then a bear trend, the double top usually comes right around the moving average. So traders look for a double top near the moving average. Here, not quite, but here, gap down, double top near the moving average. Gap down, double top near the moving average. Did not even get near the moving average and got a swing down. Small double top, big rally, stalled at the moving average, double top. When you get these trading range opens, usually you do not get a big trend. So right now, odds are, if we get a trend up or down, it's not going to be a big trend. So we're probably going to continue this trading range type trading all day. I'll change my mind if I start to see a series of strong trend bars up or down. But daily chart, look at it, 6 sideways days, right? So you have to assume today will be another sideways day. And 5-minute chart, every bar is overlapping prior bars. And right now we have 6 bars in a pretty tight range. So yes, buy signal above 10, but not a very good buy. And the bears have 9, a big bear bar closing on its low, far below the moving average, yet bulls bought it, bears did not sell it. Limit order type of trading. You can see they even sold above 9, even though outside up. But I would be out of shorts, 4, 5, 6 ticks above 7, or 1 tick above any bull bar. And swing bulls will buy above the outside up bar 10. However, they'll probably be disappointed by 11 and they'll end up scalping. For the bears, micro double top, 8, 10, wedge, 6, 8, 10. So they're hoping bar 11 will be a bear inside bar for a sell signal bar, but I don't think many bears will sell it after the stop entry bears 9 lost money. Also, we're still pretty far below the average price. Do bears want to sell this much below average when the selling is not that much stronger than average? Will the bar close on its high? Right. Will the bulls get consecutive good-sized bull bars closing on their highs? That would increase the chance that we'll get above 1 and up to the moving average. It would also increase the chance of a bull trend from the open. Location, good for the bulls. A pullback near the bottom of a 6 or 7 day trading range. We're getting near the end of the first hour. This is bar 10. First hour ends with bar 12. The bulls want bar 12 to close near the high of the day and above the open of the day, so that the 60-minute bar will be a bull reversal bar. Good location. Bottom half of the trading range, the bulls are hoping this is a bull trend, this is a bull flag. This is a breakout of the bull flag, and this is a pullback from the breakout. And then they want to get a channel up, higher lows and higher highs. So they want this first bar to be a good buy signal bar. If we get a close near the high of the bar, top half, top third of the bar, that would probably make it always in long. However, unless we get very big bull bars, a lot of traders will buy pullbacks instead of buying closes and buying above the highs of the bars. Close is important, right? Will it close on the high? Will the bar suddenly get bigger in the final seconds? Will it become more bullish, or will this be simply a bull leg in a developing trading range, which it now looks like it will be? The bears, it's a wedge, 3 legs up, 6, 8, and then 10, 11. But most bears are not going to sell below 11 if it has a bull body. So looks like we're going to go up at least a little bit higher to the high of the day in the moving average. Might take a couple legs to get up there, but it looks like we're going at least a little higher. Getting close to the open of the hour. This is bar 12. The bulls want the first hour on the 60-minute chart to have a bull body, but they need more than that. They really need a big bull body, which they're not going to get. They may not even get a bull body. However, we're probably always in long with consecutive bull bars 10, 11, and therefore probably buyers not far below 12, but not strongly bullish, not strongly bearish. Trading range open. Probably a lot of trading range trading today. Shrinking bodies 10, 11, 12. So loss of momentum as it's going up. However, it's 3 consecutive bull bars, probably buyers below 12. And we'll probably get closer to the moving average and to the high of the first hour, which is the bar 1 high. Bulls are hoping that we're getting a reversal up from a wedge down and that we get a bull trend. Here we have shrinking bodies, but then another bull body, and then we start getting bull bars closing on their highs. This is what the bulls are hoping we'll get. Gap down, wedge bottom, and then bull trend. Unlikely, right? More likely, we're going to get a lot of trading range trading today. For the bears, double top bear flag 1, low 2, 9, but 3 consecutive bull bars, probably always in long, and probably buyers not far below 13. Because it's a possible high of the day, some bears will sell it, but after the 3 bull bars, I would wait for 2 or 3 bear bars or for a second sell signal. So I would not sell below 13. Probably buyers below 13. Because it's a double top 1 and a possible high of the day, some bears will sell, but I think it's better to wait for 2 or 3 consecutive bear bars and then sell. More likely buyers not far below. Bulls bought below 1, 2, 3, 4, 5, 6, 7, 9, or 6 and then 9. So they'll probably buy below 13 as well. The always in bulls, do they get out below the bear bar? They don't have to. I think it's okay to, but they don't have to. They could keep a stop below 10, or they could wait for 2 or 3 bear bars and then get out. Not good trend trading. Traders are taking quick profits, and a lot of the trading is limit order trading. Stop order traders have been scalping below 2, below 4, above 10, and above 8, but a lot of those stop order traders also sold below 9 and bought above 3 and lost more than what they made with their stop order wins. It's more of a limit order market. You know, it's easy to trick yourself into saying, oh yeah, I would have sold below 3, I would have sold below 5, but I would not have bought above 3. Excuse me, I would have sold below 2 and sold below 4, but not buy above 5. And I would have not sold below 9, and I would have bought above 10. That's unrealistic. If you're taking the sells below 2 and 4, you're probably selling below 9, and you gave back all your winnings. And 7, not a good buy signal bar. Therefore, some bears sold the 7 high and the 9 high and sold more higher. And so we'll probably come down to that 7 high to allow those bears to get out break even. Probably buyers around the 7 high. The bears that sold the 7 high will be happy to avoid a loss, so they'll buy at the 7 high. The 9 high bears will buy at the 9 high. The bulls know that, so they will look to buy around there as well. Bulls are trying to prevent those bears from getting out break even, so the bulls are buying the 13 low, and anywhere above 7, anywhere above 9, trying to trap those bears, because if those bears cannot get out break even, they have to buy back their shorts, and that can result in a big bull bar on 15 or 16, the bears giving up. Right now, it still looks like a trading range open, but it's slightly more bullish right now after the 3 bull bars. Bulls hoping that we're channeling up. You can see the bears trying to get a reversal here. The bulls bought it. Here we had 4 bull bars, and I think better looking bull bars than what we have so far. And the bulls have buy above this bar and above that bar. Bull bars closing at their highs. Six-day tight trading range. So unlikely to get a big bear trend day today. Globex chart, a collapse. We have a bear channel, a bear break below the bear channel, and we're trying to get back into that bear channel. We're trying to get to the top of the sell climax up here. Bulls want a good buy signal bar, 15. Might get another outside up bar, like 10. And the bears will try to turn the market down at the moving average and the 1 high. Bears might be forced to give up. The bears have sold the 7 high, 9 high, unable to get out break even. And we may get 1 or 2 bull bars over the next few bars, which would represent those bears giving up. Bulls trying to get a measured move up. We have a double top. Bulls want to break above and get a measured move up. New high of the day. We triggered the buy on the 60-minute chart, but not a very good looking buy signal bar. A bear doji. Probably sellers not far above, maybe around the moving average. We're in an area where the market went sideways for 20 bars. So the bears think traders think it's a fair area, a fair price. That will also tend to limit the upside. Test of the moving average. You'll have bears selling with limit orders at the high of 1 and at the moving average. Some bears will sell the close of 15. Anytime the market's below the moving average and you get a big bull bar closing near the moving average, bear scalpers will sell, betting that the moving average will be resistance. I'm going to check a setting here. The bar numbering was not being updated until after the bar closed, so TradeStation, for whatever reason, on its own, stopped it from updating intrabar. Bulls trying to get a gap close above 13, and then a measure move up to the 60-minute moving average. And bears want a wedge with 6 or 8, and then 12 and 15. So they're trying to get a double top 1 and a wedge rally for a high of the day. The bears need a good sell signal bar 16, and bulls need follow through. They need to get a big bull bar closing above the moving average. Remember I said the bears will try to get a double top at the moving average with the earlier high of the day. Like this, double top. Like this, double top with the high of bar 1 near the moving average. Like this, double top with the high of bar 1 at the moving average, despite 2 good bull bars. Important bar 16, if it closes on or near its low, bulls will get out and aggressive bears will sell, taking a chance on the double top. If it closes far above the moving average, then we'll probably get a pretty good swing up. What's likely? Look to the left. We're reversing every couple bars or so, so you have to assume bulls will be disappointed by 16, and the bears will be disappointed as well. So it probably will not be a very good sell signal bar and not a very good follow through after the outside up 15. Not a lot of bulls willing to buy up here, and the bears need a bear bar closing on its low, preferably with a pretty good bear body, before traders will sell. Otherwise, just more sideways. Double top 1, wedge rally 6, 12, or 7, 6 or 8, and then 12. It's a swing sell 16 with a double top at the moving average. All of the reversals in here, not good for stop entry traders. Selling below 9, losers. Selling below 13 or 14, not very good. Selling below 16, not very good. You can see I said that we always get bear scalpers selling the closes of big bull bars near the moving average. If the market's below the moving average and you get a big bull bar near the moving average, there are always some bears who will sell that close for a scalp, betting that at a minimum will test down. For the bears selling with a stop 16, risk is too much. Most bears will not take that short. More likely, more trading range behavior. Buyers not far below. Example, 7 high. It looks like the bears have not yet given up. The bears have sold the 7 high. It looks like they're selling more higher. Testing the 7 high, testing the 9 high, those bears are buying, right? They're disappointed by the rally and they're thinking, oh my gosh, if it comes down to where I sold at that 7 high or 9 high, I'm going to buy back my shorts. Bulls, it's still a pullback from this rally. Now it's a double bottom bull flag 14, but big bear bar 16 at the moving average. Not a good stop entry setup. None of this is good stop entry trading. Below 13, below 16, above 14. Are we still always in long? Yeah, I think so. But if 17 is a decent bear bar closing near its low, then probably always in short. Middle of a tight trading range. Limit order trading. Most traders are better off doing nothing, although I think it was okay to sell below 2 or 4, not expecting much, and buying above 8 or 10, not expecting much. Bulls a higher low. We have a bear trend, gap down and follow through. A bull breakout. And is this a higher low major trend reversal? On the open like this, sometimes you just get a couple legs down to a higher low and it becomes a major reversal. So it's possible, but not likely. More likely, more sideways. Not a lot of bulls so far willing to buy just below the moving average, above 12, above 13. If this was taking place above the moving average, bulls would be more willing to buy. But with it taking place right below the moving average, a lot of bulls don't want to buy. They want to wait until it breaks strongly above and then buy. Possible low of the day, so it's an okay swing buy, but a small tight trading range inside of a bigger tight trading range right below the moving average, not a strong buy setup, not high enough probability for a scalp for the bulls. And if it's a swing, then we're probably going up a lot higher, and therefore you're not losing much by waiting a bar or two to see if we get follow through. Right now, too much risk. It'll do like it did above 3, around the same price. The bulls had a decent buy signal bar, and there were sellers above. Finally, down to the 7 high, which would allow the limit order bears to get out without a loss. Will they buy back their shorts? Will we bounce here, or will they hold short, hoping that we get a break below the neckline? We have a double top neckline, and the bears want to get below last week's low. Because last week is a bad looking sell setup, it's a doji inside bar, probably buyers not far below last week's low. Big bear bar closing on its low, so you get some buy the close bulls. They bought the 7 low, the 9 low, the 16 low. In trading ranges, traders think opposite. Anything that looks bearish, especially near the bottom, is a better buy than sell. Anything that looks bullish, especially near the top, is a better sell than buy. Most traders better off just waiting for a decent stop entry setup. Bulls trying to get a higher low major trend reversal. It would be better if the bulls had gone above the 17 high and then it came down here, because this would be a second entry buy. For the bulls, just like the bears had a wedge, 1, 2, 3, 4 top, the bulls now have a wedge bottom, 1, 2, 3. Is it back to always in short? Probably not, but if 19 is a decent bear bar, then it probably is back to always in short. Bears need a couple consecutive bear bars to make traders think they've regained control. Can you sell on a stop below 7? Well, that's interesting, right? This is bar 19, so we have the 18 bar range. And if we break below the 18 bar range, in general, only 10% chance we'll go up to the high of the day. There's one exception to that, and today's the exception when the range is very small. If we break below 7, maybe 20% chance, maybe even 30% chance we'll also go above the high of the day. And the opposite is true. If we go above the high, maybe 20 or 30% chance we will also go below the low. When the initial range is very small, there's a higher probability that the market will trade both below and above. Bears want to break below the 18 bar range. When the 18 bar range is very small, there's a higher chance that a bear breakout will lead to a bull breakout, or a bull breakout will lead to a bear breakout. Small height to the range, small 18 bar range, not very tall. Bears trying to get below last week's low. Really annoying that we have to keep doing all these adjustments. Anyway, this is last week's low. Fairly far below. I suspect we're not going to get there, but it's around a measured move down, double top, neckline, measured move down. Okay, consecutive decent bear bars, always in short, but bottom of a trading range. So not very good sell to close. We went above the high of the first hour. We were right near the low of the first hour, so the 60-minute bar might become outside down, but the location is bad. We're in this tight trading range, and the bottom of a larger trading range lowers the probability of a big trend down. Trading range, usually you have both a double top and a double bottom. We have the double top, bulls trying to get the double bottom, but 6-bar bear micro channel, consecutive good bear bars, 18, 19. Most bulls will not buy above 20. They'll wait for a micro double bottom. Very common for the market to be near the top or bottom of the 18-bar range and then reverse. That's what the bulls are hoping. But the 6-bar bear micro channel, a lot of the bulls will not buy above 20. Possible low of the day, so you get a higher low major trend reversal. But the 6-bar bear micro channel, I think, lowers the probability. A lot of times when you break above the range, you first test near the bottom of the range. Here's the 18-bar range, the blue box, and it reversed up from near the bottom. Here we got a new low of the day, but it was bar 18, and we reversed up. Another example, sold off and reversed up right before bar 18. So swing by above 20, higher probability, wait to see if we get 2 or 3 bull bars. Breakout mode, double top, double bottom. Probably we'll either get a measured move down or a measured move up. 60-minute chart, bears trying to get an outside down bar, unable, and now the bulls will try to get a micro double bottom on the 60-minute chart. Bears low 1 below 21, but they need a bear bar. And the bulls have a decent bull bar 20, and they're trying to get 2 or 3 bull bars, and they're trying to get closes above the moving average. Bears sold moving average 15. You'll have some bears selling the moving average here as well. They'll sell the close of 21 if it's at or below the moving average, looking for a scalp. And bulls are hoping that we get 2 or 3 consecutive bull bars and 1 bar closing far above the moving average. That would increase the chances that we've seen the low of the day, or at least the low of the next couple of hours, and that we get up to the 60-minute moving average. Same as 15, you'll get sell the close bears selling the close of a big bull bar closing just below the moving average, but they'll scalp. And the bulls are hoping that this is the low of the day. I think it's always in long. We have a decent double bottom. We're at the bottom of a tight trading range on the 60-minute chart. 60-minute chart, bull trend. We have a double top, bulls trying to get a double bottom. But the bulls need to get above the moving average. 1 big bull bar closing far above the moving average will make it likely that we're getting up to the 60-minute moving average. The bears are hoping that we continue to fail at the moving average. Rally, fail, rally, fail. Market keeps, once it gets below the moving average, every time it gets near, bears sell, bull closes, betting that they'll be able to turn the market down every time. And that's what we're deciding right now. Are we in a bear channel? Will we keep failing at the moving average? Or do we have a double bottom? Is this just a pullback? And will we successfully break above the neckline, the 15 high? A good sell signal bar, 22, they want the bar to close near its low. And bulls want a big tail on the bottom of the bar to discourage bears from taking the short. Still breakout mode, so it's still not clearly bullish or bearish. Just like you have bears selling bull close 21, you'll have bulls buying bear close 22, depending on trading range trading. You can call it a tight trading range, you can call it a triangle. We have a lower high, we have a higher low, we have 3 highs, 1, 2, 3. This one's a little bit above that, but it's a tight trading range with a double top and a double bottom breakout mode. I think always in long with consecutive bull bars, but that could change very quickly. A single big bear bar could flip it to always in short. The targets are the 60-minute moving average above, and then last week's low below. And we're about the same distance from both targets. 60-minute moving average, last week's low. Getting near the end of the second hour, and so far it's a bear body. SDS, which is the upside down version of the spider, 2 times the leverage, looks like a bull flag. We have a double bottom, reversal up, and a pullback to the moving average. So SDS looks more bullish than bearish. So the SDS is probably always in long, and that means the E-mini is probably always in short, despite those 2 bull bars. So I'm changing my mind about that. So it's slightly more bearish than bullish. Best choice, flat. Wait for the breakout. Second best choice, trade with limit orders. There are probably 15 decent limit order trades so far today. Apex of a triangle. So theoretically it's a buy above 23 and a sell below 23, but I think it's better to wait. If we get a second bear inside bar of 24, that would be a better looking sell setup. Breakouts can be fast, 1 or 2 big trend bars up or down, or they can be slow, 3, 4, 5 consecutive small trend bars up or down. Breakout mode, are we going to get the breakout or the reversal? For the bears, it's a triangle. You can call it a double top 15. You can call it a test of the moving average, but fairly conspicuous tail, bottom of 25, and more of a limit order market. Not a very good sell below 25. Because it's a possible high today, swing traders can take the short. I would not. Right now, I think traders should wait. What happens if we get a decent buy signal bar 26? Then you have a double bottom 22, 26. If it's a pretty good bull bar, I think you could buy for a swing, taking a chance it's the low of the day. And if 24 or 25 closed on their low, then I think the bears would have had a decent stop entry sell, but they did not get that. So now the bulls will try to get a decent stop entry by 26. The bigger the body, the more likely they'll get a swing up. If it's a 1 or 2 tick bear body, or if it has a 3 tick tail on top, most bulls will wait for a break above the moving average and then buy after they see the breakout. Just like bears are waiting, they're not happy with 24, 25. Suppose 26 closes on or near its low. Can the bears sell? It would be a better sell than 24, 25, but it would have the problem that it would be selling in the bottom third or so of a tight trading range. So not a very good sell. But okay, so trying to get 2 bear bars, 3 bear bars increases the chances that the bears will get their breakout. Is it sell to close yet? We're probably always in short, but we have not yet broken out. Just like the bulls need a close far above the moving average, the bears need a close below 7 or below 19. Just like the bears sold bull closes near the top of the range, 15, 21, 23. Bulls will buy bear closes near the bottom, 19, 27. It looks like we might get a third consecutive bear bar. That increases the chances we will get the bear breakout. So it's becoming more and more sell to close. Bears need the bar to close on their low. Bulls trying to get another reversal up, double bottom 7, high 2, 20. So a terrible bar for the bears, decent bar for the bulls. Swing by 28, not high enough probability for a scalp. And the bulls need a break above the moving average. What about the 3 bear bars? Well, that's a reason why a lot of the bulls will not buy above 28, but the bears had their chance. They needed 28 to close on or near its low. We still have 3 minutes left, and it still might close on or near its low. But that was a reasonably strong reversal up from below 20. So you had limit order bulls overwhelming the bears. So you had some bears selling the breakout below 19. We have a double top neckline, but there were more bulls buying. So we still have a lot of limit order trading range mentality. This low from a couple days ago is minor, not important. I'm going to erase that. New low of the day. In general, only 10% chance we'll get back above the high of the day. With this range as small as it is, it might be 20% chance that we'll get a new high. Bulls giving up. Ticks minus 1,000, so that's typically not going to be the final low in price. We have a new low in price. When you do have a failed breakout below the 18-bar range, the failure usually comes within the first 2 or 3 bars. So bulls trying to get a reversal up from below the bottom of the 18-bar range, but they need a good buy signal bar. And 28, no. If 29 is a decent bull bar, then they'll buy. But right now we're still on the short. 4 consecutive bear bars, moving average. Bulls are hoping that the breakout below the 18-bar range fails. And when it does, it typically fails pretty soon after the breakout, but the bulls need a bull bar closing near its high. Breakout below the 18-bar range, the blue box, and reversed up above that bull bar. A couple bars later. Broke below the 18-bar range, reversed up, bulls buy above bull bars. This is what the bulls are hoping will happen. They're hoping the breakout fails. Here's the 18-bar range. It broke below several hours later, but within a bar of breaking out, it reversed up. The bulls need a bull bar closing near its high, otherwise we're still short, and right now the odds favor lower prices. But if 29 closes on its high, the bears will exit above it, and bulls will start buying. With the 4 bear bars, some bulls will want a micro double bottom. For the bulls, it's a high 2 legs down, 1 pullback 2 in a trading range, and a failed breakout. With the 4 bear bars and the market being below the moving average, most bulls will not buy above 29. They'll wait for 2 or 3 bull bars or a micro double bottom. Bears, I would get out 1 tick above a bull bar. For the bears, 29 is a low one sell signal bar, but so far not a strong bear trend. That's the low one, but not high enough probability for a scalp. You're only selling that if you're swing trading. We've had lots of reversals today. We have not had a strong bear breakout, so it's still not yet clearly the start of a bear trend. Bulls want a micro double bottom 30-28, but 5 consecutive bear bars, a lot of bulls will not buy above 30. They'll wait to see if we get 2 or 3 bull bars. Bears, I would get out above any bull bar. Bulls hoping that we have a failed breakout below the 18 bar range and that we reverse up to the top of the range. The more it closes on its high, the more willing bulls will be to buy above the 30 high. But 5 consecutive bear bars, I think better to wait for 2 or 3 bull bars before buying. It's below 29 and a bounce tells you that a lot of the bears scalp for 1 point. And if they're only scalping for 1 point, that means they do not have a lot of confidence that this is going a lot lower. Still sell the close, sell for any reason. Bears trying to get down below last week's low, but not a good sell signal on the weekly chart. Yes, pull back to the moving average, but a doji bar, so a weak sell signal bar, and 4 very big bull bars, and therefore bad stop entry sell below last week's low, which means there are probably more buyers than sellers below last week's low. Markets move in the direction of where they think they'll get more trading. And here we're going lower in price, but volume is getting less, so less trading, and ticks are getting higher. Look at the lows in the ticks. So fewer and fewer stocks are going down, and the total volume of trading is getting less. That reduces the chances of this going a lot lower over the next few bars. For the bulls, a big high 220, a bigger high 27, but 7 consecutive bear bars, depending on which, if you count 24 and 7, and bears trying to get an 8th bar with 31, and bulls trying to get the reversal. Not a strong buy, even though it might be the low of the day. Bears, I think, get out below any bull bar, and they'll get out above any bull bar. Okay, that's a doji bar. Will the bears get out above 31? Not necessarily, but I would get out 4, 5, or 6 ticks above any bar, including a doji, or even including a bear bar. Probably a minor reversal after 8 bars down without a bull body. First reversal up probably will not get very far. Daily chart, parabolic wedge buy climax, 1 pullback, 2 pullback, 3. Expect a couple legs sideways to down, 1 pullback, 2. So we've met the minimum objective for the bears to double top these 2 highs. Neckline, measured move takes us to the February low, which is where I think we're headed at some point over the next few weeks, sometime in February. We may first go up, we have a double bottom bull flag, we may first go up here and then down there, but I think we're going down there at some point in February. Going above the 31 low, triggering the high 2 with 20 or the high 2 with 7, but 9 bars or 8 bars without a bull body, probably a minor reversal. Can you sell the 31 high? Well, where have the bears been successful recently? Moving average, and therefore it's probably better to be selling closer to the moving average. Bull bar closing on its high, but 8 bear bars or 8 bars without a bull body. First reversal up probably will not get too far. Limit order market, so you expect bulls to buy below 7 and below 19, and you'd expect both to make money. So they buy the 19 low, they buy 2-4 points lower, and then they sell, take profits when it gets back to the 19 low. The opposite of the bears who sold above 7 or above 9. They sell more higher, and then they buy back their shorts when it gets down to their first sell. Still always in short, but fairly climactic. Micro double bottom, you can call it a wedge with 19 and 28. You can call it a high 2, you can call it a bigger high 2, but too many bear bars. Most bulls will only buy with limit orders below things, below 29, below 28, below 34, below 33, below 32, below 31. Minor reversal, so you will get bears selling 31 high and selling more 1, 2, 3, 4 points higher, and other bears selling at the moving average. Micro double top 30, 34, but I think most bears would rather sell higher, closer to the average price, moving average. SDS, the ETF, that is an inverted splitter. It's 2 times the leverage, but the shape is the same. The bulls broke above a double top with 6 consecutive bull bars. This is more likely a pullback, and we'll probably get at least one more push up, and then maybe a wedge. 1, 2, 3. Then the bears might be able to get a reversal. So probably buyers below that low, even buyers below this low. Buyers around this high, buyers around the moving average. So low probability sell after, here we have 7 consecutive bull bars on the SDS. It's an upside down version of the E-mini, basically. So probably sellers above 31, 32, and probably at least one more leg down. Might get a wedge bottom. One, 2, 3. We already have a wedge. 1, 2, and 3. Bulls need a strong break above the moving average, or a wedge bottom, or another double bottom, before traders will be confident buying above the low. In other words, buying right here above 32. Most bulls do not want to take that buy. 15-minute chart, similar to what we had the other day. Where was it? Over here, bull bar. It took several attempts to bottom on the 15-minute chart. A couple buys there, not good. I buy here, not good. Buy here, buy here. It took several reversals before the bulls got a bounce. And bulls today, we have a buy above that, and not very good, and a second buy above this, also not very good after 2 big bear bars. Back to the 5-minute chart. That triggers the 15-minute buy. 33, a multiple of 3, corresponds to the close of a 15-minute bar, and it's at the high of the past 3 bars. So the 15-minute bar is a bull bar closing on its high. But 6 consecutive bear bars, not a good stop entry buy. Better to wait to see if we start to get 3, 4, 5 bull bars, and especially closes above the moving average. or go sideways and get a double bottom, or a little bit down and get a wedge bottom. Getting near the moving average, so you'll get bears looking to sell up here. You can tell by the way I'm talking, I'm not expecting a big bear trend, and therefore it's either a bear leg and a weak bear trend, which it is so far, or a bear leg in what will become a trading range, which is likely, and that means we'll probably get a bull leg. However, the bottom is not yet very good because of the 8 bars without, or 7 bars without a bull body. The bulls will probably need some kind of a double bottom, 31, or a wedge bottom. For the bears, a low one, a pullback to the moving average, about 4 bull bars. The bears need a micro double top, or at least a bear bar closing near its low, and the bulls need a small double bottom. Still always in short, but not very bearish. The market will probably have a swing up today, and it's deciding, is 31 the low of the day, and we don't know yet. It does not look likely. One big bull bar closing far above the moving average would be enough to represent bears giving up and flip it back to always in long. Remember I said the bulls who bought the 19 low probably would make money. A lot of trading range trading. So they bought the 19 low, they bought more 1, 2, 3, 4 points lower, and they were able to get out with a profit. We're in the sell zone now, up by the moving average, and the bulls want to break strongly above it, and the bears will sell, hoping to get another reversal down. We had a double top here, reversal down, double top here, reversal down, and here only a single top. So a lot of the bears will wait for a micro double top. This is high enough up to make a wedge less likely now, so I get rid of that line. And TradeStation, I hope it deletes the correct line. Remove trend line, and it did remove the correct one. This is bar 35, bar 36, multiple of 12, end of the 3rd hour. The hour opened with bar 25, and the bulls would like the hour to have a bull body on the 60-minute chart, so they'd like bar 36 to close above the open of bar 25. Not likely, but if we do get it, that would make the market always in long and increase the chances that we've begun a swing up over the next couple of hours. Bulls need probably one more bar to make it always in long. Single big bull bar closing far above the moving average would do it. Bears selling bull closes at the moving average, 35. They're selling limit orders at the moving average. But 6 bar bull micro channel makes a lot of the bears prefer to wait for a micro double top. Will the bulls get their breakout or not? Probably not. But that does not mean the bears will get a reversal. We may simply go sideways for a few bars after a 6 bar bull micro channel. Minor reversal means it may fall far enough for a scalp, but it's probably not going to fall all that far and then go sideways. Bulls will try to buy maybe a 50% pullback, maybe the 31, 32 high, maybe a test of the 20 low. Another minute left in the hour. Bulls trying to get another bull bar. Bears might sell with limit orders above bars or 35 close at the moving average, at the moving average, but not many bears will sell below 36, especially if it's not a pretty good bear bar closing on its low. Tight bull channel, if we get a reversal, probably minor. Limit order bears sell 35 close, sell more higher. They made their money. limit order bear sell moving average and then sell more 1 point higher. They've made their money. Stop order bears, we have now a 7-bar bull micro channel, so not a lot of bears willing to sell below 37 because 7-bar bull micro channel, buyers somewhere below 36, maybe down around the 31 high, the 20 low, somewhere a 50% pullback. So not a strong sell with a stop. So what do you do here? You either look to buy around a 50% pullback. You can buy the 37 low, scaling lower. It's probably better to wait a few bars and see what we get. Well, we're in the middle of a quiet day, so we may just simply go sideways here for a few bars, and the bulls will try to get a high 1 or high 2 buy. We're probably always in long, but traders are mostly scalping, and a lot of the trading is limit order trading. For the bears, I think they need at least a micro double top. Bulls try and get an outside bar, but not a good stop entry buy for a scalp. We're probably going to be sideways here for several bars. So anybody buying above 38 probably is better off with a stop below 31 or even below that, because we know there probably will be buyers below 31 as well. When there's a lot of limit order trading, traders buy below everything, below 37 and below 31. And they'll also sell above everything as well, above 36, maybe above 38, I would not, and probably above 25 if we get up there. And swing bulls, we're probably always in long. So if you had to do anything, it's a buy, but I think I would wait for a second entry buy if you're looking for a stop entry buy. Limit order traders, they bought the 37 low and they've already scalped out. Bears trying to get a low 2 short at the moving average, below 39. Higher probability than below 37. 37 we had, 8-bar, 7-bar bull micro channel. First reversal down, traders buy it. But now the bears have a low 2. More bears will be willing to sell below 39, especially if it closes near its low. However, I think there probably are buyers not far below, so not a very good stop entry sell. Always in long, but the bulls need to get above the moving average. They have 2 closes above the moving average, and although it does not look important, it's important. Bear trend days that keep failing at the moving average have a hard time getting closes above the moving average. And here we have 2 consecutive closes at the moving average. That lowers the probability that this is going to be a bear channel, and it increases the chances of what I said, that we had a bear leg and now we're in a bull leg in a training range day. Bulls hoping it's a bull trend reversal, down for the first half of the day, up for the second half of the day, but no momentum up or down at this point. It could come at any time, but even if the bulls go up, they'll still have a hard time getting above the 60-minute moving average. That's the low 2 at the moving average, but so far, small pullback bull trend. We have a single pullback on 38. Makes sideways more likely than down. The bulls a high 2 with 38. Another close above the moving average, but a tight range. We're always in long. Stop for the bulls, I think, is tricky. If you buy above 40, you put your stop above 40, below 38, below 31. All of those are reasonable. Bears need a better sell signal. Here's one on micro double top. Bulls have a high 2. Some bears are selling, taking a chance, expecting it to test back down. But right now it's a small pullback bull trend, and it's a high 2 just above the moving average for the bull bar. So I do not take that sell. I would not sell the 40 high with the limit order, even though I think we're probably going to come down. I don't know if we're going to come down from here, or after going sideways more. For the bulls, I'd get out below any bear bar, 39, 41. Terrible math for stop order traders. It does not matter that I suspect we're going to get down to the 31 high. This is not a very good looking sell. Very tight range. How far down does it have to go to get back to always in short? Probably a new low today. And we're probably going to get a higher low. This will probably stall where it stalled earlier today. The 7 low, the 19 low, and which would be around the 31 high, 32 high. It'd also be about a 50% pullback. In the buy zone, I suspect we have to go a little bit lower, but bulls are looking to buy. They might buy the 42 close and scale in lower, or they might wait for it to go a little bit lower and then start to buy. Market traders bought in this general area twice earlier today. We broke below it, could not stay below it, broke above it, so it's probably a support zone. The bears have a bear trend, and the bulls have a reasonably strong minor reversal, and that increases the chances that they will be able to get a major reversal. So let's say we go sideways to a higher low over the next 5 or 6 bars and get a decent buy signal bar. The bulls would have a higher low major trend reversal and head and shoulders bottom. So left shoulder is a double bottom, then we have a head and then a right shoulder here. And for the bears, they're still on the sell below 41, but I think most bears will scalp. Even though we're in a bear trend, the bulls owned the market for a lot of bars. So about 8 or 9 bars here and then another 8 or 9 bars here. That is a lot of bars. It reduces the chances of today just continuing down in a channel like this. We have much stronger selling here and here than what we have today. We got pretty good selling here, but I still think today's reversal up is stronger than that or that. It's even stronger than this. So that reduces the chances of this going much lower. 3 bear bars, even though higher low major trend reversal, bulls prefer to buy both bull bars. And after 3 bear bars, a lot of bulls will wait for a high 2 instead of buying above 43. Decent bull bar, bulls trying to hold above the moving average. We probably stayed always in long with that sell-off. Not a great buy. We're at the top of a bear channel and at the moving average. We've been failing at the moving average all day. So far, everybody's scalping and mostly limit order scalps. 44, decent bull bar. We're stop order bulls, but 3 bear bars, probably more sideways. Remember when we broke below the 18 bar range, I said only 20% chance, maybe 30% chance we get above the high of the day. But every bar that we add to the rally increases the chances of a new high. So maybe we're up to 40% chance of a new high. Broke below the 18 bar range and went up and tested the high. Broke below and then above. Pretty good bull bars. That makes it a higher probability to buy. We're not getting these yet, but if we start to get them, then we could get a pretty good rally up to the 60-minute moving average. Broke below the 18 bar range. A lot of bull bars sideways and then some trend resumption at the end. Small pullback bull trend. Never looked all that strong, yet the pullbacks were small, 1 or 2 bars and just a few ticks. That can go on a long time. For the bears, another lower high in a bear channel and a lower high double top 41, but I think always in long. If 45 ends up as a decent sized bear bar closing on its low, bears will sell. But anything less than a pretty good bear bar, traders I think are still more inclined to buy, betting that we'll get a new high and
get up to the 60-minute moving average. Strong trends are clear, and this is not yet cleared, and therefore it's not yet a strong trend. Strong trend, traders buy above bull bars closing at their highs, even if we're at the high of the day. And we do not yet have that. We're trying to get that, but we do not yet have it. This is the neckline of the head and shoulders bottom. So it's good for the bulls to break above 41, but the bears will try to get a reversal, 2 legs up, 1 pullback 2, just like when we had a new high of the day 15, we had 2 legs down, 1 pullback 2 and a reversal. Now 1 pullback 2 and the bears want a reversal. Trading range days have a lot of 2-legged moves, and the second leg is often pretty strong. And it's an attempt to break into a trend. However, despite the second leg being strong, it typically reverses. I don't have the examples that I want. Well, we had that example last week. We had a lot of wedge type patterns, but basically 2 legs up, 1 pullback 2, 1 pullback 2, 3. Close above the moving average, good for the bulls. Did not get above 41, but probably will. Trading range days usually go above important resistance before reversing down. 15 went above 1, and they usually go below important support before reversing up. We went below 7 and reversed up. So we're probably going above 41. And the bulls hope for a breakout and a measured move up to the 60-minute moving average, but they need better bars. They need bigger bars closing on their highs. And the bears will try to get a reversal down, but they need a pretty good sell signal bar. So it's still slightly more bullish than bearish. Higher low major trend reversal, pretty good minor rally, and a sell-off in a trading range on the 60-minute chart. In trading ranges, you get rallies, you expect them to reverse down. You get sell-offs, you expect them to reverse up. For the bears, double top 41, but 2 pretty good bull bars, probably more buyers than sellers below 45 or 46. Surprise bar increases the chances that we're going up to a new high. Bears hoping second leg trap, first leg pullback, breakout. When you get these surprise bars, the bigger they are, the more likely you'll get a measured move up. And the next bar is important. How this bar closes is important. If it closes with a big tail on top, it will increase the chances that this is just a trap, a failed breakout above 39. Breakout, gap, 47 close above 45, but big tail, and look to the left, still a trading range day. So not good by the close. If the next bar is the bear bar closing on its low, especially near the bottom of 47, it would be a sell signal bar for a second leg trap. Leg 1, pullback, leg 2, failed breakout. 8, a multiple of 12, corresponds to the close of the hour. Possibly the first bull bar of the day, 60-minute chart. Buy signal bar for a pullback from this rally. Bulls need the bar to close near its high, but even then, it's a 4-bar tight trading range, not a strong buy setup. For the bears, second leg trap, 1 pullback 2. 2 legs up, 1 pullback 2. A bigger second leg trap, 1 pullback 2. Very strong rally, but bears still sold it. When you get these second leg traps, they're characteristic of trading range days, and therefore you're not expecting a bear trend, but you're expecting a bear leg in the trading range. 1 pullback 2, bear leg in the trading range. 1 pullback 2, bigger, 1 pullback 2. Breakout, it failed. Small 1, pause 2, second leg trap in a
bear trend day. One, pull back. Two, you look to the left at resistance, the high of today, the high of yesterday. It trapped bulls into hoping that this would be the start of a bull trend. Instead, bull leg in a trading range, bear leg in a trading range. If 48 closes on its low, bulls get out. Bears might sell. It's a reasonable sell, but I think we're always in long. And right now, I'd say at least a 50% chance we'll get a new high of the day. The bulls have owned about 20 bars now, with a lot of bull bars, not much in terms of bear bars. Reduces the chances of a big sell-off. Swing sell, probably buyers not too far below. We finally get above the moving average for several bars, and therefore the moving average is now probably support. That lowers the probability for the bears selling below 48. Traders selling 23 high, selling 47 high. Will the stop order bears sell below 50? They might, but in general, it's easier to make money trading with limit orders when you're placing trades in a trading range day, unless you have a clear second sell signal. And 49 did not go below 48, and therefore it did not trigger the first sell signal. I think that lowers the probability for the stop order bears. We got a wedge sell-off here and a wedge rally now. Trading range days tend to be filled with a lot of two-legged moves and wedges and then reversals. I sold with a limit order 4 ticks above 47, and I've already scalped out. For stop order bears, you got 8-bar bull micro channel, not really a good stop order setup. I said that buying above 31 was not a good stop order buy, and we've rallied for 2 hours since then. Same thing here. This is not a high probability stop order sell. Probably a minor reversal. What's different between this and that is this, I thought there was a reasonable chance that it would be the low of the day. And here, I think I don't think it's going to be the final high. Is it possible that we've seen both the high and low of the day? It is, but I think it's more likely that we're going to go to a new high. A lot of time left in the day, so we could go sideways for several bars to test the moving average. Moving average resistance for the first half of the day, and it should be support. So there should be buyers around the 49 buy climax low, which is right around the moving average. For the bulls, a high one, a pullback, and a bull trend, but above the moving average, and the rally is not all that strong. So yes, it's a high one, but it's probably better to buy closer to the moving average. Small wedge, 47, 51. This would be a higher probability sell than below 50. It's a perfect double top, 15. Do I think we'll get a big sell-off? No. We're in a small pullback bull trend. Remember, I showed those examples of failed breakout below the 18-bar range. Bulls are hoping for that, but I also showed breakout below the 18-bar range where the market rallied, but could not. I'm trying to find this one particular chart. I'm trying to find. Here's an example. Broke below the 18-bar range, rallied for several hours, got right up to the top of the 18-bar range and failed.
So this is what the bears are hoping will happen today, that we're getting a perfect double top at the top of the 18 bar range. I would get out of longs below 52. And bears who want to take a chance, it's a swing sell. Tight bull channel, trading range day, unlikely to lead to a collapse, but might test the beginning of the wedge, 48 low, the biclimax low, 49, moving average, breakout point here. If it has a 2 or 3 tick tail on the bottom, a lot of the bears will not take the sell. The bears unable to get a close on the low, that will discourage bears from selling below 53. Bulls, I would get out below any bear bar, 53. We have a double top 15. We have a small wedge. So I would get out of longs below 53. And for the bears, yeah, you have to wonder why they could not get the bar to close on its low. Something's wrong. Not all that bearish. But trading range day, a lot of times you get reversals that just do not look all that good. You know, buying above 7 didn't look good. Buying above 31 didn't look good. Selling below 24, 25 did not look good. That's the nature of trading range days. Setups tend to be disappointing. Traders tend to be confused. The one thing traders are confident of is that it's probably not going to become a trend. So we can trade down for a couple hours, but not have a bear trend, trade up for a couple hours, not have a bull trend. Probably support below around the moving average 47 low. And more traders interested in selling with limit orders above things, above 47, above 40, above 50, above 51. Some traders will sell the close, bear close 53. I was going to sell below 53 if it closed on its low, but it did not. So right now I'm trapped out. And can I buy on a stop above 15? New high of the day. The math is probably okay to do that, but the day is so quiet that, you know, look at it, we're down and up and down and up. Range is fairly tight. In general, I prefer to look to sell whenever the market goes up 10 or more bars and is near the top of the day. And I prefer to look to buy if it goes down 10 or more bars and is near the bottom of the day. So this is the sell zone. However, for me, not a good enough stop entry sell. This is what the bears want. They want, and this is what the bulls want. They want a breakout below the bottom and then a breakout above the top. But this rally is much stronger than the rally we have today. Here we broke above the top, pulled back, and then went higher. I would not be surprised if we got something like this, double top, then pull back. Right now we have a double top. Bears want to pull back. And then we break above, pull back, break above, work higher. Double top like today, pull back, became a bull flag, went a little bit higher. Broke above and just sold off the rest of the day, not very far. As you can see with the examples I have, if you break below the bottom and break then above the top, most of the time it does not go very far up, just like it did not go very far down. Another example, below the 18 bar range, above the 18 bar range, below, and here a double top like today. The bears had to have it go sideways for a few bars. And then once they get that big bear bar, a give up bar, traders were more willing to sell. Bears selling, but not a good stop entry sell. You get bears selling about 54 because it's not a good buy. It's a small give up bar. It could lead to a couple legs down, but support moving average 49, buy climax low. High to at the moving average. But where's your stop? Your stop is probably all the way down below 43 or 31. A little bit of a surprise bar, 55. Probably we'll get at least a small second leg down. It's always in long. I doubt that we're going a lot lower. But I gave these examples where you test the earlier 18 bar range high and then collapse. We have a reversal down, but nothing like that. I doubt we're going to get that. So pretty much difficult to do anything right here. We're in the buy zone, but next support level 43 low. The shorts were up here, less so down here. Bulls trying to get a small wedge, high 3, 54, 56, 58, and most bulls want 58 to close on its high. And maybe it's better than a 50-50 chance we'll go up a little bit, but it's a trading range day, so the probabilities are less than we think. So we could trigger the buy above 58 and then immediately reverse down below 57 and fall for a measure move down to 43. So that's just the nature of trading ranges. Nothing is as clear as you want, and nothing is as certain as you want. Bears, I would not be short. Had I shorted, I would have sold the 54 high, and I debated it, did not take it. And the bears need to do more to attract sellers down here. They need, a big bear bar closing below the moving average or several consecutive bear bars. And for the bulls, it's a weak buy. It's a wedge bull flag, high 3 with 54, 56, also a wedge with 51 and 55, but a tight trading range and a doji buy signal bar. Really not very good trading. This is what I was talking about, how the wedge could trigger, go above 58, and then reverse down and fall for a measured move. And that's why I did not buy it. Too high up in a trading range day and not a very good buy signal bar. And not much momentum, but basically 10 bar tight trading range. And I did not sell it either. I did not sell above 58, did not sell below 57. So right now I'm trapped out. Trapped bulls panicking out. Thinking that we now may stay below the moving average and get down to the 43 low. Very difficult to trade this, especially with stop orders. It's more of a limit order day, which we knew right from the outset. Here we were having a lot of bear bars, and bulls made money buying below every one. When you have these small buy signal bars, 58, if you buy above, I rarely would ever put the stop one tick below 57. I might put it 4 ticks below, 5 ticks below, because so often whenever you have a small buy signal bar, your risk is small. And small risk equals low probability. That means you typically get stopped out. However, the bulls are trying to resume the bull trend. Sometimes they need a second or third attempt. What happens is a lot of times the buy triggers, goes above 58, the stop gets hit, goes below 57, and then reverses up again. That would be a higher probability buy if the bulls were to get a good buy signal bar on 61. And for the bears, they're trying to get a gap. They want to get a measured move down below the wedge bull flag. They want to get back down to the 43 low. I'm not doing anything here. If it accelerates down, I'll sell. If the bulls get a good buy signal bar 60, I might buy above 60. Bulls hoping 59 is a late bear trap. Not a very big bar, so it's not trapping a lot of traders. However, it's like I said, 58, credible buy, not very good, but credible. A lot of times it'll trigger, hit the stop, and then trigger a second time. And 60 is the attempt to trigger it a second time, but the bulls want a bull bar closing on its high and closing above the moving average. Otherwise, they'll wait. about a 50% pullback from the rally that began 43, and bulls trying to get an IOI, an inside bar after an outside bar. Most importantly, they need the bar to close near its high and above the moving average. The bigger the bar is, okay, so that's a credible buy, not a great buy. Bears are hoping we're in a small pullback bear trend, but more likely we're going to try to get back up there. Everything is really small. You know, first target is a lower high, 59, which is very close, and then possibly up to the high of the day, but I think that's less certain. What do you do if you're a bear? You have outside down 55, outside down 59. I would get out of shorts above 60. I still think we're always in long, but I think the bears need to do more to flip it to always in short. They could get a single very big bear bar closing on its low, that would flip it to always in short. For the bears, they want this to be a double top, 59, but it's a small wedge. It's this tiny spike in channel pattern. Bear breakout 55, first push, second push, third push. So we get a reversal up from a tiny wedge. Odds are we'll get at least a small second leg up. Therefore, more likely buyers than sellers below 62. Now, what about that small wedge with the spike down 55? It's a smaller time frame pattern, and it's possible that the second leg up is 62. We went up on 61, down on 61, up on 62. So that might have met the objective of the bulls, 2 legs up. For the bears, it's a lower high. They want a lower high major trend reversal, just like the bulls had a higher low major trend reversal, 43. Small pattern, usually not going to lead to a major reversal, usually not going to lead to a bull trend. And the same is true here, 63, a lower high major trend reversal, but only 3 bars up, too small to reverse a major trend from bull to bear. And therefore, if it does go below 63, it's probably a minor reversal, a leg in a trading range. Bulls trying to get back to the 60-minute moving average. 60-minute chart, 6 doji bars at a price where the market went sideways last week. Does not look like we're going to go very far up or down today. Now, can the bear sell below 63 if it closes on its low below the moving average? They can take a chance that we get a second leg down to 43. But when I look at this, I think for the most part, limit order trades. So I'm not going to sell below 63. I'm not going to buy above 63. I'm going to wait. A lot of bars here, about 15 bar tight trading range. You get occasional stop entry trades, but most of the trades are limit orders. And if you do take stop entry trades, like above 58, it's better to use a wide stop. Can you buy on a stop above 15? You know, when a day's a trading range day, and it's at the top of the day, and I'm looking to buy, I prefer to buy with limit orders, not with stops, although I did buy above 60 for a scalp. Also, if it gets above 15, the 60-minute moving average is not much further above, and therefore probably not a lot of profit potential. For the bulls, it's a head and shoulders bottom. We have a double bottom left shoulder. We have a right shoulder. If you want, you can call it a double bottom right shoulder. And they're trying to get a break above the double top and the 60-minute moving average. And they're trying to close the gap. Remember, we gapped down today. It's still possible that we could get a reversal up at the end of the day. But it's really a problem for the bulls. They have a double top, they have to get above that, and then they have to get above the 60-minute moving average. And chances are they will not get above the 60-minute moving average. However, if we start to get a series of bull bars closing on their highs, I'm going to start buying closes or buying above bull bars. Not yet, though. I want to see the market get above the 60-minute moving average.
Does it look like a lot of bulls bought with stops above 15? Not a lot. And right now there's not a lot of follow-through buying because traders are concerned about the resistance of the 60-minute moving average. At a minimum, the bulls want the day to close above the open so that it will have a bull body, and that would be a higher probability buy signal bar for tomorrow. And we're right around the open right now. And the bears obviously always want the opposite of the bulls. They're hoping that bar 81, the final bar of the day, closes below the open of bar 1. But a small bear body or a small bull body does not matter. The small body is what matters. It's obviously a little bit better for the bulls to get a small bull body, but simply having a small body is an expression of neutrality. We've been in a tight range for 7 days, and we're right around the middle of the range. You know, we gapped down here, well, we gapped up here, we gapped down here, we gapped up, we gapped down, but there's no follow through. Market's in breakout mode. Now, if you want, you can call this an expanding triangle. 15 went above 1, 64 went above 15, and you can also call it a wedge, 39, 53, but pretty tight bull channel. I think not a very good sell below 65. Also a surprise bar, 64. Stop order bears, I think, should wait for at least a micro double top. Will the bulls buy the 64 low or 65 low, top of a trading range today? I would not. If we get a pullback, a high one pullback, 66 or 67, you know, bulls might buy that, but most bulls are not going to buy the 65 low because it's a possible failed breakout above the trading range. And for the bears, this is not a dramatically strong sell signal bar, and that's what the bears need after a tight channel here and a tight channel here. So probably more buyers than sellers below 65. I'm going to take a look at ticks after this rally. Oh, that's interesting. We put up a 5-minute chart. First time all day that we hit plus 1,000. Therefore, this high is probably not the final high. If we pull back for 10 bars, even 20 bars, we'll probably put in a new high of the day. So this is probably not the final high. We're probably going a little bit higher. Can you buy above 66? I think it's really not very good. Surprise bar up 64. Expect at least a small second leg up. Highest tick reading of the day, 65. Probably at least a little bit higher, but the rally is not particularly strong, and we're right below the 60-minute moving average. And therefore, a lot of bulls will not buy above 67 or 68. Really nothing to sell. You could sell with limit orders 66, 65. I would not. You know, where are the bear bodies over the past 7 or 8 bars? And even in this entire rally, there have not been big bear bodies. So it's still more bullish than bearish, but not very bullish at all. And the day probably will close around the open, forming a doji bar on the daily chart. Not enough traders willing to buy at the top of a trading range today, right below the 60-minute moving average. And for the bears, it's an II, but 3 dojis and a pretty tight bullish channel. So a lot of stop order bears will not take that short. What about the high tick reading up here? Well, sometimes you get a high tick reading like that, and instead of going to a new high, we go sideways. Twice the bulls tried to go to a new high, here and here. Both times failed. And now the bears are getting a reversal down. We still could get back up to a new all-time high. We've had a big pullback in ticks. So from plus 1,000 to minus 600 or something. And so we'll probably get a bounce. You can see when ticks get really low, usually buyers come in and you get a bounce. When ticks get really high, usually you get sellers, bulls taking profits. So
as far as ticks go, we're in a buy zone. But 5-minute chart looks like 68 is reversing 64. And most bulls will wait to see what the next 2 or 3 bars will look like. They're not going to buy above 68 if it's a bear bar. For the bears, we're still above the moving average. There was resistance the first 30 bars of the day first, and it's been support the past 30 bars of the day. We're testing it right now. On these quiet days, I take fewer trades than I do on other days, and I make less money. However, I don't force anything, and when I take trades, they have to make sense. I have to be able to structure a sensible trade, and I manage them well. And obviously, I take a lot more 1-point scalps on a day like this, but that's because it's the most appropriate way to trade this. Bulls testing the 65 high and the 60-minute moving average, but not a good buy signal bar. 68 and 69, not a very good location. Wedge rally just below the 60-minute moving average. So I'm trapped out right now. That's the buy signal bar, but you're buying right at the top of a pretty quiet day and right below the 60-minute moving average. So I think it's not a good stop entry buy. I am willing to buy closes and buy both bars, but I wanted to break above the 60-minute moving average, and then I'll see how strong it has become. Right now, not strong enough. 1-minute tick traders, they bought the reversal up with very low tick reading. Sometimes I do that, just when you have a strong tick reading and then a very negative tick reading. The probability is good. The math is pretty good for buying, especially when you see a reversal up on the tick chart. So we can see this little reversal corresponded to the buy signal bar on the 1-minute E-mini chart. That little dashed line is the 5-minute moving average. You can see there's also a pullback to the 5-minute moving average, as was this sell-off. You can see we just touched the 5-minute moving average and reversed up. That's another attempt to get a new high. And at this point, I think that the significance of the 1,000 tick reading is gone. We had a 10 or 20 bar pullback, and we had a test up, unable to get the new high. So I think at this point, the market's ignoring that 1,000 tick reading and now is looking at whatever comes next. This was the attempt at a new high, and it looks like it failed. Stop entry bears, double top, 65, failed breakout high today, expanding triangle, 115, wedge, 39, 53, failure at the 60-minute moving average. So a lot of little things good for the bears, but pretty tight bull channel and holding above the moving average for 25 bars. All reduce the probability for the bears selling below 70. Late in the day to be buying with limit orders 69 low, or even selling with limit orders 68 high. So difficult to do anything right here unless the character of the day changes and we start to get a series of bars up or down. Tight range between two average prices. High one, but bear bar, doji bars. So the rally is getting weaker. It's still always in long. We still have a high one. Traders are aware of the 60-minute moving average, just a little bit above. Bulls still trying to get a new high in price after that tick reading of 1,000. It's possible we could accelerate up. Tick reading of 1,000 is very bullish, but it often represents exhausted bulls, and they'll take profits for 10 or 20 bars on the 1 minute chart. When they buy back, sometimes they'll buy back aggressively, and we don't know yet if this is going to be an aggressive move up. We're right below resistance, 60-minute chart. Too late in the day for me to sell 70 high with a limit order, although the math is okay. Traders sell it and sell 1 point higher, or simply sell 1 point higher and look for a scalp. Bulls have their objective, a new high after the tick extreme on bar 65. That will encourage some bulls to take profits and look to buy lower. And the bears need a good sell signal, bar 71. Getting near the end of the 6th hour, bar 72, and the bulls trying to get their first good bull bar all day. It'll be 3 consecutive bull bars, good. Double bottom bull flag, good. But not a very big bull bar. It still looks always in a long 60-minute chart. Bull trend, double top, double bottom. Still more likely we go higher than straight down. But even if we do go up to that December 12th lower high, the crash high over here on the daily chart, I think there'll be sellers not far above, and then we'll come down to the February 2018 low. Now, what about selling below 72? Still have the wedge, 39.53. Still have the expanding triangle, 115. We have a second leg up, 64, and then second leg up. But we also have a very tight range and no momentum. You can get a surprisingly big move up or down, but that's unlikely. More likely, what we'll get over the final 9 bars is what we've had all day long. Quiet trading, mostly sideways trading, and no big moves. So not a very good sell, below 72, right above the moving average. Not a very good buy, above 72, right below the 60-minute moving average. Best choice, I think, is flat. Trading range day, open of the day, always a magnet at the end of the day. I said earlier that the day would probably close or end with a small bull or bear body. The open of the day is right here, a little bit below that red line. Sell signal, but tight trading range and right above the moving average, not good. 73, a buy signal, but right below the high of the day, and a weak rally and right below the 60-minute moving average, not good. So it's a swing sell, hoping for a surprise move down, low probability bet, and the bulls, the opposite's true for the bulls buying above 73. They're hoping for a surprise move up, unlikely. Beyond up longs here below 72. It's a credible sell. And for the bears, it's a credible sell, but a low probability sell. So I did not take the short. But if I had to be long or short, I would be short right now. The bears have a second sell signal, 74, but same problem, right above the moving average, and a fairly tight bull channel. Bulls trying to get a high 2 bull flag. The high 1 above 73 did not trigger, but they're trying to get the high 2 above 75 to trigger. I think the math is not very good here to do anything. My general rule, one of my many general rules, is if the market's in a tight trading range at 1245, bar 75, it's usually not worth trading for the rest of the day. You can see we're very close to the open of the day. Here's the open of the day.
daily chart, doji bar. I said, I've been saying all day long, it'll probably end up with either a small bull body or a small bear body. Bear is getting a series of bear bars. I'm flat, and I'm not doing anything here. The bears who sold below 72, 74, 75 have made money. Bull channel, bear flag, but not much energy. There's not much sense that the price is very wrong, and that limits how much the market will move. Sell the close started at 12:30. A lot of times you'll get a buy the close or sell the close trend starting around 12:30, 12:35. Double bottom 68. Bull bar but tail and 3 bear bars. 6 bar bear micro channel, 7 bar bear micro channel. Not a strong buy. The bears who did sell closes and below bars obviously get out this late in the day. And with so little energy, I think the best choice is just wait. Quiet day, trading range day. We've been getting gaps up and down on the daily chart. We gapped up, gapped down, gapped up, gapped down. So island top, island bottom, island top, and we may gap up tomorrow. And that would turn today into an island bottom. On the daily chart, we have a double top and a double bottom. Breakout mode. To me, it looks like we're probably going higher above the December 12th high. But I also think that we probably will not get much above it, and that we're going to test last February's low at some point this February. So always in long, but climactic major resistance, probably will get a pullback. We had a big gap down, and first bar tail, not a lot of sellers below. Then we got consecutive bear bars, bar 2, and one of the 2 bars closed on its low and had a decent body, bar 2. So we're always in short. It's sell to close. Traders will sell below 2 if they're willing to risk a lot. They probably have to risk above 1 because by the close of 2, there probably were sellers above 1. But anyway, if you sold below 2, you probably would get out above 1 and then look to sell again. And then bar 3, a possible failed breakout yesterday's low. But with the 2 decent bear bars, 1 and 2, it's probably better to wait for a second buy signal, which came above 7 or 9. We had 3 legs down, bear bars bull, bear bars bull, bear bar bull. Traders will buy above the bull bar 7 or 9, 8 or 10, looking for a test of the moving average. And the bears will try to get a double top bear flag. So bear trend, double top bear flag at the moving average, and then a swing down. And the bears got it. They have a micro double top, 13 and 15, a bear bar closing on its low. But there were a lot of bull bars in the first 15 bars. And if we sell off, that reduces the chances that we'll fall very far. We'll probably have maybe a weak bear trend and then a reversal up. I talked about that in the sell-off, 27, 28, 29, 30. I said that, it's a whole bunch of bear bars and it's a new low, but the bars are small and we had a lot of good bull bars earlier, and we're at the bottom of a 7-day trading range, and therefore it's more likely that we'll get a reversal than a continued bear trend. The bulls had a small wedge at 32, closing on its high, failed breakout low of the day, and it's a nested high 2. There's a small high 2, one pullback 2, and a bigger high 2 on first leg, pullback, second leg. A possible low of the day. It became always in long, probably around bar 35, but some bulls bought above 33. The bears had a double top, 39.41 at the moving average with a decent bear bar, but too many bull bars here. We had, I think, 7 or 8 bars without a bear body, and therefore, if we do get below 41, which we did, we'll probably form a higher low. I said we probably would test the 31 high and maybe the 7 low, and then the bulls would buy, trying to get a second leg up, a higher low major trend reversal.
probably a minor reversal. It turned out to be fairly major. We rallied for the remaining 40 bars of the day, but with so few bars down, typically you're not going to get a big bull trend out of it. So for the bulls, the buy is above 44, and not a lot of good buying up here. Buying above 49, bull bar closing on its high, but look to the left. We sold off, so not a great buy. We had a wedge rally, 49, second entry, 54 or 55 outside down, but I thought this channel was tight enough and the entire channel was tight enough, so the reversal down would be minor. If you bought above 58, you're buying above a small bar. Small bar means small risk. Small risk means low probability. If you take the buy, you probably need a wider stop, like below 43. And the bulls got a better buy above 60. We got a new high of the day, 65. So we had a break below the 18 bar range and then a break above the 18 bar range. And usually when that happens, you don't go up all that far. Today is an example of that. The bears wanted a wedge with 39, 53, 65, but too many bull bars, channel too tight. Probably buyers not far below 66. The bulls had a high 169, but a big bar, big risk, right below 60-minute moving average, low probability. The bears had sells for a wedge, sell below 72 or 74, wedge 39, 53, or expanding triangle, 115, and 71. But the channel up is tight, the entire channel is tight. We're probably not going all that far, especially with the market being sideways for about 8 bars late in the day. Usually the market's not going to go very far. Trading range today, open of the day, magnet at the end of the day, probably small bull body or small bear body on the daily chart. And we had this little rally, 77, double bottom bull flag, 68. But after 3 bear bars, not a great buy. And we bounced a little bit up into the close. For stop entry traders, let me zoom in a little bit. For selling, I would not sell below 1. It has a big tail on the bottom and it's far below the average price. Big tail means not far above average bearishness. I don't want to be selling far below the average price. Bar 2 you could sell, but I thought we were going to go sideways with that tail on the bottom of 1, the bars not being all that big. I said I thought we would go sideways to the moving average and try to get a double bottom or a wedge bottom, and the bulls would try to, a double. I said we probably would go sideways to the moving average. The bears would try to get a double top or a wedge top, and the bulls would try to get a wedge bottom, and the bulls did. Stop entries below 2, okay. Below 3, I would rather wait for a second buy signal, which is above 10. And the first 9 bars limit order bulls made money repeatedly buying below strong bear bars, 1, 2, 4, 7, 5, 9. And if the market's going to be in a big bear trend, that should not be happening. That does not commonly happen in a big bear trend, and therefore this early sell-off is probably not going to get far. We're probably going to rally up to the moving average. So stop entry bulls, the first buy, either above 8 or above 10. What about buying above 11? There's room to the moving average, room to the high of the day, bar 1, maybe, but we'll get that tail. And then the bears got a second entry short below 16 at the moving average, but pretty good bull bars, probably not going down all that far. So I would get out of longs, and if I were trading always in, I'd sell below 16 and buying above 20 for a higher low major trend reversal, a double bottom, double top. It's probably going to be a minor reversal up to the moving average. However, if I were trading always in long, I'd get long above 20. And for the bears, they sell again. They have a micro double top. You can call it a wedge, 17, 21, 25. Their sell would be below 25 or 26. You get long over here. We have a wedge bottom, micro double bottom. Bulls get long above 33. I would get short below 41 if I was trading always in short, looking for a higher low major trend reversal. Bulls would buy above 44 or 46. I'd get out either below 49 or 64, and not a really good short below 50. I said 54. I need to get out of lungs below 54, maybe below 55, definitely below 55, but not a good sell. I thought we were going to get a pullback and another leg up. So bulls get out below 50 or 54 or 55. Bears, I would not short below 55. And bulls, they can buy above 58 if there's a wide stop, otherwise buy above 60. I would get out below the II 67 because it's an II, a credible sell setup, and a wedge with 39 and 54, and also a failed breakout high of the day, expanding triangle 1 and 15. Good enough reason to get out below 66, but I don't think it's good enough reason to sell. I would get short below 72 or 74, and then long again above 77. So reasonable stop entry trades below 2, most traders should not take it. And then above 8 or 9, okay. Below 16, not great. Above 20, not great. Below 25 or 26, not great. Above 32, 33, 34, 35, none of it very good because it's a limit order day, trading range day. Below 41, no, not great. Above 44 or 45, 46, okay. Above 60, 61, okay. Below 72, 74, okay. And above 76 or 77, I'm sorry, if you have energy. Buy the close, sell the close. It's not a trend day, and buy and selling closes is trend type trading. However, if I were trading buy the close, I would buy the close of 10 or above 10, and 11 maybe. We have that tail. And then I talked about how when you have a lot of trading range trading, traders tend to do the opposite. If you get a big bull bar near the moving average, traders sell the close of the bull bar, 15, 21, 35, they scale in higher. And then once you are above the moving average, they do the opposite. If you get bear bars, big bodies closing near the moving average, traders tend to buy the close, 55, 59, 75, 76, betting that the market is not going to convert into a trend, and therefore attempts to convert into a trend will fail and we'll get reversals. So not great buy the close, not good stop entry trading. But if I were buying closes, I'd buy the 10 close or above 10, maybe above 11. And then here, sell below 26, 27, yes. 29, yes. Buying maybe above 32. And then up here, probably buying above 46, even though it's not a bull bar closing on its high. And here, 60, 61, probably buy above 61, 62 maybe, but we're probably going to stall either at the 15 high or the moving average. And then this does not buy or sell the close. Limit orders, in terms of realistic limit order trades that traders could take. If you're really aggressive, buying below 6, not ideal. Selling above 14 made sense. Probably selling above 22 made sense. Buying below 36, you're right at the moving average. Not great, but you have 6 bars up. And then here, probably sellers above 51, above 50, above 15. Here, not all that good. Up here, probably sellers above 68 and sellers above 70. That would be it. So unless you're really an aggressive limit order trader, a day like this, first of all, it's not all that fun. It's really pretty boring, and you're not going to get a lot of trades. If traders are just looking for the best trades today, I would buy above 10. I would sell below 16, and I would be looking for maybe 2-point scalps, maybe selling below 26, 27, 29, buying above 31. Selling below 41, buying above 46, 40, buying above 44, 46, 60, buying above 60, buying above 64, closing on its high, selling below 72, 74, and maybe buying above 77. Question, do you have any thoughts regarding using stochastics to help determine always in on trading range days? For example, today, bar 14, the stochastic showed overbought. Today, the 14 bar stochastic showed overbought at 15, 40, 49, 64, and oversold 19, 31, 59, 76, all great swings. Okay, now you bring up a really interesting point, okay, that when the day is in a trading range like today, any kind of an oscillator, overbought, oversold indicator is going to work great because it's a trading range day. Anytime it goes up, you have to look for reversals down. Anytime it goes down, you got to look for reversals up. And you can do that using an indicator, stochastics, RSI. I've written all kinds of oscillators, including complex versions of stochastics. Some of them are over the internet. Let me just take a look. I don't know if I have any on this chart. No, I don't have it over here, but for me, I ask myself, why bother? It's as soon as I know it's a trading range day, anytime it goes below something, I'm going to look for to buy a reversal up. Anytime it goes above something, I'm going to look to sell a reversal down. And having a stochastics show me that it's overbought or oversold does not give me any additional information. And as a crutch, it tends to draw my eye to the indicator and away from the chart. And I'd rather just focus on the chart. And so that's one. You can also put bands up. You can put all kinds of indicators up. But for me, I'd rather just focus on the charts. I've written a lot of indicators, and I know the kinds of things that traders look for when they write indicators. And I see them on the chart, so I don't need to have the indicator tell me what I already see. So if the bodies start to get small and the close is starting to get above prior closes of prior bar, any kind of indicator is going to start to turn up. And I don't need stochastics to tell me that these bodies are shrinking and now we have a bull body, and therefore you got to be looking to buy. I can just look at the chart and know that. I don't need a stochastics indicator to tell me we went up. Oh, we went up a second time, we reversed twice. We probably have a little stochastic divergence. I don't need an indicator. I can see it right here. I can see it. So I can draw a stochastics. You know, just looking at this chart, I can draw what a stochastics looks like because it's based upon what is taking place here. So for me, I'd rather just look at the bars and trade what I see. If you ever watch TV shows on trading, like Fast Money, that's an example. How often do you hear them talk about RSI or stochastics? Virtually never. Sometimes a couple of them will mention RSI, but for the most part, they're trading and they're not using stochastics. And why is that? Because they don't need them to make money, and it's a distraction, and they don't want to be pulled out of a good trade because the stochastics does not look quite right, even though the chart does look quite right. And in a strong trend, stochastics will constantly, let's say a strong bull trend, stochastics will constantly be overbought and constantly forming divergences, and they'll be constantly looking to short when that's the exact opposite of what you should be doing. You should be looking to buy. You should buy closes, buy above bars, buy pullbacks. So that's why I don't bother with stochastics. However, if you can make money using stochastics and you're happy, those are the two objectives every trader has in trading: consistently making money and consistently being happy. And I don't care how you achieve that. I don't care, if you're standing on your head or dancing or singing or looking at stochastics or, I don't care what you're doing, watching TV, watching cartoons. If you're making money and you're happy, to be honest, I'm going to admire you and respect you for what you're doing. Right? You're a pro. And if for you stochastics works and you're happy and you're profitable, then that I think it's perfectly reasonable to do. But for me, it's a distraction. And as I said, I look at the chart and I know what any kind of, you tell me the indicator, I'll tell you what it looks like. Right? I've written a lot of indicators, and looked at the formulas for a lot of indicators. I know what they're looking at, and I don't need them to tell me what the chart is telling me. If the market's going up and I'm seeing a lot of tails and reversal attempts, well, guess what? You're going to start to get divergences on every indicator. And I don't need that. I can just see it. I know it. Right? Okay, question. You say the math is okay. How do you know for sure? Doesn't the math depend on the stop placement and the profit target? How can I quickly determine the math for the bulls and the bears? When I say the math is okay, what I'm talking about is exactly what you're saying, profit and reward. The math is okay. Math, for me, means trader's equation, and that means three variables: risk, reward, and probability. And when I say the math is okay, what I mean is that a person can structure a trade where the trader's equation is positive, and they usually can structure one where the trader's equation is reasonably good. And for me, if you've been listening to me for any length of time, you know I tend to prefer high probability trades. Some of the low probability trades have tremendous math. They have huge reward, very little risk, and even if the probability is only 40%, the math is fantastic, because if you make 4 times your risk 40% of the time and you lose that risk 60% of the time, you're going to make a lot of money. So when I'm talking about math being okay, I'm looking at the stop, I'm looking at what kind of reward I think is reasonable, and I assess probability. The general rule of thumb is if it looks like it's reasonable to go for a reward that is twice the risk. So if I buy above 32 and I put a stop below 31, is it reasonable for me to expect the market to go twice that distance? Yeah, it is. So it's an okay swing buy. And even if you only win 40% of the time, it's a profitable strategy. So that's what I mean when I say the math is okay. I'm talking about the trader's equation, and that means you're looking at where your stop would be and where your profit target would be, and you're determining probability. In general, if you cannot tell what the probability is, assume that it's at least 40%. For 90% of the bars on the chart, the probability for the bulls and the probability for the bears hovers between 40 and 60%. Looking at bear stairs trend, how do you wait for the trend to slow down or automatically buy a new low for a scalp as long as the bulls made a bit of money in the previous low? So when the market is trending down in the stairs or trending up in the stairs, do I automatically sell the 39 high, or do I wait for a pullback, or do I sell 1 point above, 2 points above? There are a lot of variables involved. If I'm pretty confident, let's talk about a stairs up like this, a channel up, where the pullbacks overlap the breakout points. If I'm pretty confident that the market is not going to break into a strong bull trend, a lot of times I will sell at the high. If I think we're late in the trend, I'll sell at the high or 1 or 2 points higher, or at the high and 1 or 2 points higher, or I'll wait for the market to make a high and then have a big tail on the bar, top of the bar, especially a bear close like 53. I may have sold the 53 close for that very reason. Or if you're really aggressive, you could flip up a smaller time frame chart, a 1 minute chart, a 10-second chart, a 30-second chart, or a tick volume chart, 1,000 contracts, and look for a reversal. So there are many ways to do it. But if I think that the trend is weak and I think the channel is probably a leg in a trading range, I am looking to buy, let's say a bull trend, I am looking to buy pullbacks, and I am looking to sell above the prior high. And depending on how strong the legs up are, that determines whether I sell exactly at the prior high or look for a higher high from prior back, or wait for it to go up 4 or 5 or 6 points, thinking it's going to come back below the 39 high and sell anywhere up there 4 or 5 or 6 points above, or find some reason to sell up there. Okay, question. After achieving consistent profitability, I've had a hard time finding new material to study. I've been reviewing previous material that got me to becoming consistently profitable. now I find it to be boring to keep reviewing the same material. I'm not sure what to study to ensure that I do not degrade my skills. What do you study to keep improving after you become profitable? One thing I do is every day on this collection of PowerPoints, I just keep adding charts. So at the end of every day, one thing I do is I look at the charts bar by bar, and I look for the patterns. I have several hundred patterns, several hundred headings, all right, in this collection of PowerPoints, and I look for things that belong in one of those headings, and then I put it, I mark up the chart, put some text on it, and put it in the appropriate PowerPoint, and then at the end of the month, Richard updates all the PowerPoints. So on a day like today, well, some of the things I'm going to do. I'm going to say, okay, we have a gap down and a wedge bottom. So it's an example of a gap down and a wedge bottom. Buy above bull bars closing the other highs. I'm looking for a double top at the moving average, especially if there's a second sell signal. I want to sell below 16. So then I'm looking for a subtle wedge bull flags and subtle wedge tops to trade. Here, small buy signal bar. It's a wedge, 1, 2, 3, but it's a small bar, and therefore we're probably going below 57. Didn't run the stops and the bears, especially since it's between 10 o'clock and 11:30, when the market often traps traders into doing the wrong thing, and then I'll look to buy on the reversal back up above 60. And end of the day, I look at buy the close, sell the close. Is it starting too early? Is it does it look like it's reasonably strong? If I look to the left, am I still in a trading range? So I'm just always looking for relationships. Looking at 5-tick traps, 9-tick traps, 17-tick traps. I'm looking for bull bars below the moving average that are big bull bars near the moving average. Will I short the bull closes? Trading range day, if I see big bear bars, can I buy the close of 42? Can I buy the close of 59? Buy the close of 18 or 17? And I'm constantly looking at those things, and I would say the majority of them, I got my finger on the button to place a trade. The majority of them, I end up not taking the trade. But a lot of them are just perfectly fine. But if for some reason I look at it and say, I'll wait for the next one, there's always a next one. On every bar, there are, to me, at least 40 or 50 trades every day on the 5-minute chart. And I'm just trying to pick the best ones, and I'm trying to have a very high winning percentage, which makes me happy. So there are always challenges that you can construct. And those are examples of the kinds of things that I'm always trying to do. I'm always trying to get better to recognize patterns before they trigger. So we have a reversal up 12, but it's a second leg up. So 1 pullback 2. So we may just get one more leg up and then a wedge top. So I'm looking for that, especially since it'll be a double top with bar 1 at the moving average. So I just keep trying to anticipate patterns, thinking about what is possible. All right, I'm losing my voice, and that's it for questions. We have a buy signal bar for tomorrow. We gapped up, we gapped down, we gapped up, we gapped down, so several island tops and bottoms. And I still think it's slightly more likely than not that we're going to go above the December 12th high before we correct down to the February 2018 low.